following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today. We've got a great show lined up for you. I hope you enjoyed our 100th show anniversary last week. We'll try to follow it up this week with some equally timeless information. If you happen to miss last week's show, head on over to the web, www.dlblain.com. There you'll find archives of the shows as well as information about myself and my firm. We do this show for you, the viewers and listeners out there on 94.1 FM WNBU, as well as cable TV 10 in New Bern and streaming on the internet. I know what I'm going to say. I know the information. What we want to make sure is that it's relevant and interesting for you. So make sure that you give us a call or email. Our phone number is 252-633-0107. Our email is allthingsmoney@dlblain.com. And we'd love to hear from you. Like I said, we want the show to be interesting for you, the viewers and listeners. And just let us know what you like, what you don't like, if there's a topic you'd like us to address, or anything of that nature. Well, without further ado, let's get into it. The past couple of weeks we've been talking about some media and predictions and gurus and things like that, and I think we will do a 2012 Outlook show. Maybe next week, maybe the following week. I don't know. I need to put some stuff together. I do think it's important to take a look to the future, but one of the things that we've tried to emphasize the past several weeks is don't get all wrapped up in predictions and these market gurus. One that I like to point out, we talked about his book, or the story of him in a book called The Greatest Trade Ever. John Paulson, he was the guy that made, $15 billion or something, betting against the housing market way back in 2007, 2008, had this tremendous success, the biggest gains ever, I think, by a hedge fund manager. And so people started flooding their money to him. He started all these other hedge funds. And this is typically how it goes. You get somebody with the hot hand who makes a big return one year. People flood to him. Well, this is what happened to Paulson. I'll just see, this was from December the 6th, the Paulson Fund loses 46% in 2011 through November in one of his largest hedge funds. Paulson's Advantage Plus Fund seeks to profit from corporate events, declined 3.6% last month. He manages $28 billion and has lost money this year on investments including Citigroup, Bank of America, Sino-Forest, the Chinese forest company. He cut his net exposure to 30% last month and reduced his bullish bets across all funds. His largest fund, the Advantage Plus and Advantage, employs similar strategies, have $11 billion in combined assets. The Gold Fund has gold and other assets, rose 11% for the year. His Recovery Fund invests in assets that Paulson believes will benefit from long-term economic upturn, is down 28%, and his Enhanced Fund is down 18% for the year. Anyways, the majority of his funds are down. That one has lost 46%. The reason I bring this up, not that he's a bad guy, just that a lot of times what happens is people have a successful year, people flood money to them, and either it goes to their head and they think they know more than everybody else and they do crazy things, or simply the strategy that they use to make the money cannot support that much capital. Whenever you have, and this is something that Warren Buffett talks about, let's say you have a great idea for some widget that there's a market for 1,000 of them in the world, and you can make money on it. Well, if you have a fund that has billions of dollars, you can't put your money all into that. Let's say there was a company and you knew for sure that it was going to go up, 20% next week. And it was a little tiny company. It was worth, $200 million. Well, if all of a sudden some big hedge fund wanted to buy that company, well, they would end up buying the entire company, and then they would essentially destroy the ability of that company to rise in value. The point is that there becomes a point at which a strategy, whether it's buying a particular company or a strategy in general, if too much money is chasing after that strategy, it will no longer work. And so this happens sometimes in the hedge fund arena. But anyway, so that was Paulson's fund, lost 46%. Of course, we advocate for a little bit more even keel. Try to have a diversified portfolio. Sure, make some adjustments as we go along. The world changes, so should your portfolio. But don't make these huge bets one way or the other on this one asset class or this one strategy to try to keep your portfolio moving forward. Adjust it as markets change, but don't make these huge bets. And a lot of the times these hedge funds, when you see these huge losses, you think, how could they do that? I mean, the S&P 500 is only down, 1 or 2% over the same time frame. It's leverage. It's leverage, and that's where a lot of people get themselves into big trouble. I know we use a lot of exchange-traded funds or ETFs. Leverage, by the way, is borrowing money. So you borrow money and put it into investment. And so a lot of these new exchange-traded funds allow people to leverage their returns, which can be very, very dangerous. If you ever find yourself in the position you're borrowing money to go make an investment, you have to realize that that is a very dangerous situation. Now, real estate, that's one of the reasons when you look at the returns on real estate and these real estate investors that do very well, going out and buying a property for cash, holding it, and then selling it, the rate of returns would not be that exciting. But the beauty of real estate is it allows leverage like a lot of other investments don't. And so even when you buy your house, just think about it. You can, let's say you're going to buy a $200,000 house, and what's the down payment today? They probably 10%, would be $20,000. They probably require 20%, anyway, $40,000. But for $40,000, you can control a $200,000 asset. And during the heyday of real estate, when that was appreciating, you're leveraging your returns because you only put down a fraction of the price. When you buy a stock for cash, if it's a $100 stock, you got to pay the whole $100 unless you go on margin and borrow the money to do it. Well, that's how these hedge funds get into a lot of trouble. And as a general rule, outside of real estate, there's some good times to use it. Appropriate leverage is fine in real estate. But if you're investing in the stock market or commodities or something like that, you have got to watch the leverage. It's what takes most people down, is being over leveraged. Okay, well, we're coming up on our first break. I kind of got sidetracked there talking about Paulson's 46% loss this year. When we come back, we'll continue talking about some market predictions and how they're harmful to your wealth. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.